Welcome back, everyone, to the second episode of the Playing FTSE podcast. It's the second episode because the first one went so well. Thank you so much for everybody who listened to that. And everyone who left comments on the YouTube. It was like overwhelmingly positive, really. And we were very, very, very surprised with that. But now, thanks to Steve D, the podcast isn't just on YouTube anymore. It's now on Apple, it's now on Spotify, and it's now on Google Podcasts as well, which is absolutely incredible. I never thought we'd see something that we made on all the podcast sites, which is pretty crazy. So thank you, everyone, to that. And there'll be links in the description below of the YouTube channel video. So you can go have a listen there if you want. And if you want to just search for it on Spotify, Apple, or Google, just search for the Playing FTSE podcast. Right, today I think we've got a few topics up for discussion. We want to talk about GameStop and Robinhood and maybe even Trading 212 in there. We want to talk about a bit about diversification, and we're going to talk about some of the recent earnings reports, including, I think, Facebook, SPACs, and we might even be able to throw in Amazon at the end. I'm going to Google Amazon because I think Amazon's earnings report's going to come out in the next couple of minutes, I think. With me today, we've got Steve D, we've got Zach, and we've got Steve W. How are we doing, guys?
All good, guys. How you guys doing?
Yeah, doing good.
Very good, thanks.
Good. So let's get started because the GameStop short squeeze seems to be coming to an end. In case you didn't know, and you've been living under a rock for the past few days, GameStop short squeeze started happening where all the Wall Street bettors, all the retards on there decided that they were going to push the stock as high as they can to squeeze out Melvin Capital. And they did a pretty good job. They reduced it from 168% overshorted to 112% overshorted, I think it was in the end. It might have even gone lower. I'm not totally sure. But now GameStop, AMC, and I think all the others are starting to drop. Are the diamond hands starting to turn to paper? Anyone think?
I was looking at GameStop just recently before we came on. And I was looking at some of the closing prices from previous days, and it was, I think, 347, 194, 325, 225, and the last time we looked, it was 95. So it's coming down quite fast. I mean, even the guys from Nikola Motors think that's going downward.
Yeah,
I just feel sorry for people now because there's an element of people being duped into this, I feel now. I mean, it's got a hell of a lot of interest outside of the investing community, and anybody buying that at 325 and expecting a return, it felt a bit nuts at the time, and it is proving to be so. And I just hope that people have just invested or gambled with the money that they could afford to lose. I hope nobody's gone daft with this, and just be careful.
I think, because I was scrolling through actually eToro today, and they have, it's quite a social, I don't know if you know, but it's a social trading site, and everyone posts up their opinions, and a lot of people are starting to sound and look worried on there. It's something I was going to cover, hopefully in my next video. I'm going to look into what effect the brokers have had on this short squeeze, because as we know, Robinhood decided to cease trading, and many others, but obviously Robinhood's the one that's took the brunt of it. What do we think actually happened there? Has anyone got any thoughts on that?
So, from my point of view, I think they were partly right to kind of halt the trading. I know it's not going to be a popular opinion, but basically they had issues with the clearing houses because I think the margins that they were asking to cover, I'll say, a deposit for each trade, I think it was way too high. And I think, I'm not sure whether the clearing houses were doing it on purpose to kind of increase the deposits that Robinhood had to pay. But I mean, we know for a fact there's incredible amount of volume, and it was probably a case of where Robinhood couldn't keep up. I think it was. I know they say they were protecting themselves, and they wouldn't like to admit it. But I think it was a case of them just trying to stay afloat with all.
Well, the problem is that people think that the money flows in real time because that's what you're seeing on your screen. You're seeing you've made a purchase and that stock's arrived, but that's not really how trading happens behind the scenes. So basically, what happens is the broker tots up all the buys and sells, and it submits them at the end of the day. So when you send all your buys and sells to the DTCC, which is just essentially a clearing center, you might hope to only be sending them a little bit amount of money, and the rest of it is just electronic settles where shares are trading hands. Now, at one point, Robinhood got asked to send something like $3.5 billion of money because there was that many buys and not very many sells. I mean, no broker has that kind of liquid cash on hand, and no broker no bank would lend Robinhood that money, even at an interbank rate to fulfill that, which they have done twice now. I think they've raised $3.5 billion, and they managed to negotiate the DTCC settlement down to $1.7 billion. But that's still a hell of a lot of money for a fledgling broker to have to cover. So they had to stop the trades. There really isn't an alternative. And as much as we, the peddle the narrative of them being evil, and scum is another word I've seen, they had to save their own back, and they had to save the clients. Now, they've worded it badly. They've represented themselves terribly. I don't know whether you've noticed, Robinhood is hiring somebody who has experience of managing a crisis, and they fucking need it. They need it. And trading to as well.
Yeah, I was going to probably, for the UK users, probably move on to trading 212 in a little bit. Wall Street Bets pretty much has the idea in its head right now that the corruption in the market starts with Robinhood, because they're the ones that stop the trading or reduce the trading down to one share. Their excuse has been that these clearing houses required so much money to clear the trades, and they had to do that 3 billion volume raise. God knows where they got it from in the end. I did read it, but I can't remember. Citadel. So where, if there is any corruption in this market, where would it have come from? Who's the one that's made the call? Because obviously interactive brokers who would therefore pass on their trades to Trading 212, they're being accused of the same thing. I don't know if anybody watched the interview, the famous interview of where they saying he laughed and things about trying to halt the process and save the company, because I personally do believe that these brokers, they aren't trying to protect their customers. They don't give a shit about their customers. They wouldn't be doing options trading. They wouldn't be doing CFD trading if they really truly cared about their customers. But they were trying to protect the business and therefore protecting the customers. I get that. So if the hedge funds did have some sway, where do you reckon that would have been? Why was it they called Robinhood and said, go on, stop trading? Or did they somewhere up the list go, let's make it really hard for Robinhood to trade right now?
I guess my thought on this is that I think that Robinhood and the other US brokers, this isn't the case with Trading 212, just for clarity for the moment, I think they are protecting their customers. I really think they have their customers' interests at heart. What I don't think is that the people trading there are the customers. I think the people trading there are the product. The customers are the people who buy the order flow from them, which is hedge funds and so on and so forth. So, I mean, I guess what I'm reminded of here is we're thinking of this kind of narrative of pitched battle between the Wall Street Bets guys on one side, the hedge funds on the other side, and we're trying to work out where the brokerage goes. The brokerage goes to the guys that pay the money, which is getting paid for order flow by hedge funds, as far as I can see. So, I mean, we always think of the kind of expression of if the service is free, then you're the product. And we think about that with sort of Facebook mining your data or Google tracking your search history or something like that, so they can pass that on to other people. I think it's just as true here. In the case of someone like Robinhood, the traders are the products. The customers are the people they kind of sell the order flow onto, at least from what I can see of it anyway. I would point out that's not the same with Trading 212 in the UK. Selling order flow is, I think, illegal in the UK. Yeah. So
we'll discuss that.
Officially, no one's doing that from Trading 212, and I'm not trying to suggest they are. But in the case of Robinhood, they're perfectly upfront about the fact that that's what they do, I think.
Yeah, so Robinhood specifically, their business model is, for a start, order flow. which is one of the ones. The second one is the sale of data. They've been very clear about that in their SEC report as well. So they're actually selling their trader data to the hedge funds. So basically, the hedge funds get the volume, the volume trading from Robinhood before anybody else on the market, so they know where to put their money before anybody else does. That's one of the big ways. The third possible way, and this is speculation from Wall Street Bets and other big traders, is that they're actually betting against their customers. They needed to raise the 3 billion. It was actually 1 billion when the first accusation of this came out. They needed to raise 1 billion. The accusation was that they're actually betting against their own traders, and that was just an interesting one. We won't go too much into that one because I think that is mostly speculation. But for the UK users, Trading 212 is probably the one that's getting the most flack right now, especially if you go on Trading 212's own community forum and on the Reddit servers. We have to point out here right now that Trading 212 can't earn money through order flow. It is at the whim of Interactive Brokers, who I believe can earn through order flow in the US. They probably can't do it in the UK. But they still had to halt. Interactive Brokers state that they had to halt their trading, and now Trading 212 says that's why they had to halt GME and AMC trading on their platform. Anything more to that anyone wants to add?
Did Trading 212 kind of give an official kind of response to this? Because I've not.
Yeah, they have. They have. Again, this is the biggest problem with Trading 212. I don't want to get too much into this because I've got a whole idea on a video for this as well. But essentially, Trading 212, the two problems I have personally with Trading 212 is customer communication, which is by and large terrible, I think.
Zero.
Yeah, it is terrible. The only place I learn stuff is from the freaking community forum, where one or two of them post up the first bits of information. And the second one is they changed their story twice, and that's the one that Trading 212 Reddit users, I think, have got the big problem with, because they started off by saying they were trying to protect their customers, and blah blah blah. They tried to mimic, I think it was Robinhood at the time. They were mimicking what they were saying. And then it's come out 3 or 4 days later that it was actually down to Interactive Brokers that stopped the trades, and they have no control of it, which is my second big problem with Trading 212, is that their business model is at the whim of Interactive Brokers, and we've kind of proven that again. And that was a big problem for me.
The issue I had with 212 is the message that they put out. It sort of made sense when you had a really, really long think about it, protecting the clients from risk. But it wasn't worded at a retail investor who maybe doesn't fully understand the system. The second note they put out was a far better note. And if they would have put that note out first, there would have been less. There still would have been uproar, but there would have been less uproar. And I think that's the issue now. And then obviously it didn't help that the next day the platform goes down on US Open, and I think it was down for about half an hour. And I feel sorry for them, really, because I think they are getting a hell of a kick in, and I think there's a hell of a lot of conspiracy theories around at the moment. And I think some of the language being used is a little bit harsh, but they're not helping themselves either. There are problems that can go away with good communication, with stable servers, and with getting on top of customer service. Would be amazing, but they've had the lockdown. New registrations doesn't help. They've locked down the community today, so you can't make an account. That doesn't help. And all of these are for good reasons. Is that people are trying, because the customer service queue is so long, they're trying to get it through the community. It's not an official avenue of support. Plus, would you want your details aired in public? There's people posting up their email addresses, their account balances. All that stuff shouldn't be on a community forum. So they're right to close the forum, but they don't communicate that well enough. And hell, it must be terrible training up new staff remotely. I don't know how they're doing it, because everybody in an office, you can do group training, you can get everybody up to speed really quickly. These people are all working remotely. I do feel sorry for them, but it's got to get better, and it's got to get better fast.
Yeah, I think we've done that one to death, so we can move on, I think. what were we going to talk about next? We were going to talk about some of the actual SPACs that were going on, some of the actual stocks that were being traded up. So you got GME. I think everyone agrees that no one really wants to own GME at the current levels. I don't think anyone wants to own AMC at current levels either. Well, how silly is that? But Zach, have you seen any of these actual stocks that might actually be worth buying?
I mean, I've picked out one. I think it's kind of grouped into this new group of WSB kind of stocks now. But my pick is a turnaround story, which caught my attention around 3 weeks ago. It's not a company that gets much attention. I mean, certainly not in the Discord servers I'm in, but it's Bed Bath & Beyond, ticker symbol BBBY. So Triple B, which I'll call from here on, is a long-established retailer. It's a bit like TK Maxx, Dunham and IKEA, I guess. And if there's one thing I want to emphasize, it's this company was trash around a year ago. I mean, I'm talking like an old school management who basically just prioritized brick and mortar. So that's essentially what they did, and they just kept at it. And I think they shouldn't have really done it because they were kind of going towards the approach where Blockbuster went, which is not digitalizing their business. And I mean, if you come across a business like that today, I mean, there's a low kind of hanging fruit that anyone could come in and fix up. But yeah, so around mid-2019, the old management were kind of kicked out, and in came like a Justice League kind of team, run by run by Target CEO. I mean,
have they moved on to online? Is that where you're getting here? Have they moved online?
Essentially, yeah. I mean, it was a case where managers were so kind of disaligned with what's going on. I mean, you've got Amazons, you've got your Wayfairs who are fully up to speed with digital marketing.
I tell you what, I'm going to jump in there because Amazon have just released their reports. Who wants to hear it? Because I think that's a good segue, to be honest with you, into Amazon right now. I'm just getting it, so I haven't really digested this yet. But let's have a quick look. I'm seeing some pretty big numbers here.
That'll be down in the morning then.
Oh, wow. Okay, so operating cash flow increased 72% for trailing 12 months at 66.1 billion. I'm just trying to find. Net sales increased 44% and net income increased to 7.2 billion in the fourth quarter.
Wow. Bezos is standing down as well.
Standing down from
crazy.
Yeah, Andrew Jassy from AWS is taking over Jeff Bezos as CEO during the third quarter of the year. There you go. That's big news. Yeah, just
reading that now. That is huge news.
Huge news.
Wonder why he's doing that. Is this sorry, we're just digesting this at first, but they are huge numbers and Jeff Bezos is standing down. Is this going to be the breakup of Amazon? Is that what they're going to plan to do? We haven't done enough research here, have we, to go through this right now?
I would say no, but I do wonder whether Amazon's founder now being out of the picture might make them a more attractive antitrust target. I mean, that's wild speculation. There's always antitrust swirling around Amazon. Bezos, of course, has a great story about having come from nowhere and no thing. I wonder whether someone else in charge might be a more attractive-looking target, I suppose.
Loses its founder-led leadership, though, doesn't it? That's one of the big talking points at the moment, right?
Just see that earnings per share number. It is double what was expected.
Yeah.
You normally beat it by 2, 3, 10% in a good double what was expected.
Yeah. So, I mean, we're shooting from the hip here and we've only got the numbers, right? I mean, it's really a detailed story with Amazon. I mean, it trades on a massive P2E, but one of the reasons it trades on a massive ratio like that for price earnings is partly because people believe that a lot of its earnings are getting recycled elsewhere. And they've got earnings that they could kind of let out a bit more easily if the time came to do that, or they felt the time came to do that. So I guess this is one to look at kind of a bit more closely and dig into a bit. But
yeah,
I mean,
I'm just comparing
the
it
sales
with
growth is one that's kind of hard to do much with, other than be impressed by. Sorry, Paul.
Yeah, no, I'm just comparing it to Alibaba's earnings at the minute. Just on the news right now, it's down 0.5% and dropping. So there you go. That's the news. That'll be solely down to the Jeff Bezos news, won't it? Really. But Alibaba actually had a net profit of 9 billion, I believe, in comparison to Amazon's 7.4 billion. So
Wow.
it's there's some really different numbers. They are, and Alibaba lost about 3% today on that news. So
Google's have just
the market.
Have you seen that? Google's have just dropped now. There's a pretty impressive revenues up 23%, which is nuts. They've beat on earnings by $7 a share. They've Google Cloud hasn't done as well. Only just above what the analysts were expecting. YouTube ads are way above. Traffic acquisition costs were about $1 billion more. Cloud business lost more than $1 billion last quarter. That is big news. Big news.
And by contrast, there, that Google is up 6.37% on that news. So, wow, the market is absolutely crazy at the minute. I don't know if anybody needed to know that because no one knows what's going on. Right.
Yeah, this is going out on a Wednesday, of course. We're recording this on a Tuesday.
Yeah, this is
just for clarification.
This is the moment.
The market is halved.
Yeah.
Right. Let's see. So let's move on to the topic of the day. Then we'll move on to diversification.
Yes.
Go for it.
I'll start off. I'll start off with something. So Mark Cuban, we all know him from the TV show.
Loudmouth fuckwit hedge fund owner. Is he a hedge fund owner?
Pretty much.
Yeah. Is that the name of his hedge fund?
Right. Okay. So basically, he said portfolio diversification is for idiots. What do you guys think?
Yeah, I agree with that. But I tend to have a perhaps slightly broader net for idiots than Mark Cuban does, basically. I mean, if people are idiots by not being Mark Cuban, who, whatever you think of him, has significantly more money than I think all of us put together, and has made more money than all of us put together. I kind of think there's something right about that. I think the more of an idiot, i.e. the less you know, the more you should diversify. So I tend to think of diversification in various forms. It can involve buying more stuff, or it can involve buying it more often, basically. So if you're not sure what a good price is, then dollar cost average and buy it at every price for a company. And if you're not sure what a good company is, then buy them all via an index fund or something like that. And that way you will just catch things at the right time and the right stuff, as long as the general trend is going in your direction. So yeah, I agree with that. Probably wouldn't put it that way, but I'm okay with that idea.
Is diversification a bit wider than that, though? When we say diversifications for idiots, I'm sure Warren Buffett's had the same ethos as that. I'm sure he said that he'd rather his family be in the US index fund rather than owning all of his stocks, which is probably a fair thing. You know, if you don't know, like you said, go into your index funds. But what about further diversification? Are stocks the only place to be at the moment? What do we think?
Maybe at the moment, but I guess you could think about sort of diversification in terms of being ready to move into other stuff when it appears at the right price, whether that's commodities or crypto or gold or, I mean, not now, but bonds. When bonds become a reasonable kind of price. But I tend to think diversification is including that, yeah.
Because that's my issue with diversification at the moment, because I do see a place for bonds. I do understand previous to this, probably 5 years ago, I would have understood that bonds would have been the better place for me to put my money because I'm quite a cautious investor. But right now, we've got extreme asset inflation, really, haven't we? Well, it's for me to say extreme. Others might not say so extreme. But I personally feel that we've got extreme asset inflation. So there isn't really anywhere for us to put our money. Cash is trash, right? No one wants to put our money in cash. You're just going to be waiting while the asset bubble inflates and inflates and inflates, and you'll lose loads of money.
Nobody wants to be in bonds. Nobody wants to be in bonds. I don't want to be harsh to bonds, but I was a former bondholder, and they're known as income generators in your portfolio. So the idea is that they're steady. They work inversely to your stocks. So i.e. when your stocks go down, your bonds will go up, or vice versa. And they're supposed to pay a steady coupon, 2-3%. At the moment, the bond yield is next to nothing. It's effectively the same as having cash. You may as well stuff that cash in your mattress, but there is a small chance that your mattress might catch fire because there's that much government debt around at the moment. It's just not worth having. I mean, if you were talking buying emerging market bonds at the moment, you've got to be nuts. There's going to be countries left, right, and centre that are on the verge of default. You might get a half decent yield out of it, but the risk is ridiculous. You could put it in a SPAC. It's just as risky.
Oh, we all sit here and laugh like with a pipe in our SPACs. Except they're earning 100% every single day right now, right?
Mm-hmm, pretty much.
So who's the winners? Who's the losers here?
Bonds are the losers.
Yeah, bonds are the losers. Yeah. We can all group together and just look down on bonds, right?
Sorry, what happened to not being harsh to bonds or whatever you said at the start?
Yeah, straight in there. Oh yeah, bonds suck.
It's bad cop, bad cop.
Right. So, anyone got any stocks that they feel are of interest at the moment? I'm looking at you, Zach.
Let's have a look. Can I go back to the BBBY? There's one particular area that they focused on. It's got some astounding numbers. So their digitalization kind of campaign. So basically,
so are you seeing that BBBY as a sort of turnaround stock at the minute? Is that what you're going for?
Definitely a turnaround. I think they're basically rock bottom right now. I think the last management left them at the worst possible scenario. I think so. The new team. So they kind of glossed over the websites. They've got some baby kind of verticals as well in their company. And recently, over the past 6 months, 2.5 million app downloads. And this is quite staggering. So 1.4 million customers were brand new to the company. So these customers have never, ever shopped at BBBY, ever. And their customers are now 6 years younger on average than their current base. So, and they've also found that, because BBBY is famous for their coupons. So they got these 20% off coupons, and they found that the younger demographic, they're not willing to, or they don't really care about the coupons, which is a good thing because they improve on their margins and their revenues overall.
I don't personally follow coupons or anything like that, even though I should be saving a lot. I totally get that. Why do you want to be storing stuff up to think about for later? Everything's ease, right? And that's where Bed Bath & Beyond are planning on going, I guess. I mean, I don't know for sure.
They're forecasting around 3 billion in sales via digital only. I mean, at the moment they're doing around 12 billion, which in this case is about 25%, right? So that's quite staggering. I mean, if that's just an addition to their already kind of revenue stream, I think they have an opportunity to keep going over the years.
Well, actually, yeah, I'm just looking through their quarterlies now, and while they are down year on year, like you say, they had a 11 billion revenue year on year. Right now, quarterly, they're just running 3 billion, and you're saying that's all from digital sales? I guess their company has been largely shut, has it, during the pandemic?
They were affected. I think the kind of the turnaround strategy was affected as well. So it's not the best time, in a sense, to kind of to introduce a new strategy, because I think people are gonna keep them on hold and say, okay, how long will it take? But it's gonna take, I think, a few years. It can't.
So we're seeing this as a value play. I didn't see that coming from you, Zach. I thought
This is it, because I've been into my small cap stuff. I think Steve D pushes these new kind of stocks that I've not come across, and I thought, hang on, maybe I can have a look at something I've never decided or kind of looked at before. And I think this goes with Steve W's as well, with his value plays as well. So, it was interesting. I think it was something that I saw, and I thought, okay, maybe it could be a growth stock.
That's interesting.
Yeah, for the record right here, I just want to finish off on this one that it was $25 pretty much before the pandemic. Got pumped and dumped by Wall Street Bets all the way up to $52, and I believe it's now back down to $25. So that's what it was at its original valuation, right?
Yeah, I think because they had quite a large short interest in it as well. I think the bandwagoning happened over the past 2 weeks. So I wouldn't buy at this price. Well, it's gone down now recently, but I wouldn't have bought when it was about 45.
I don't think anyone was buying for the business. They were sticking it to the man, or at least they thought they were sticking it to the man, right?
I think because it is a turnaround. I think the WSB folks are like, okay, let's turn it around in 2 weeks, essentially. I don't think it quite works like that, but it's no telling those guys.
Yeah, so speaking of unknown, well, I suppose it's not so much of an unknown stock at all, but Steve D usually goes to the Amazon rainforest to find his stocks. That's just a running joke we've got because he's into Mercado Libre and all the other random Brazilian stocks. What stock are you looking at the minute, Steve?
Normally, I like a stock that I can't pronounce, but this one I can. I've been looking at a company, and I own this stock called Demtech. And normally, when I'm looking at sort of medical or tech stocks, there's sort of like a list of boxes that you want to tick to make sure that they are better than what's already there. Are they cheaper than what's already there? Is it going to be something that doctors will want to use, and is it something that patients will want to use? And Demtech is all of these things. So essentially what Demtech does is it's a little plaster that you put on your skin, and you leave it on for a few seconds, and you pop the plaster off, you put it in an envelope, and you send it off to the clinic, and it gets checked. And what it checks for is for a melanoma, so it's a skin cancer. So really serious stuff. It's got a 99% detection rate. It currently replaces a punch biopsy, which is essentially somebody jabbing a hole in your arm. It leaves you with a scar. Demtech doesn't leave you with a scar. It can be painful. It needs to be sutured back up. There's none of that with Demtech. Demtech is 25% cheaper. It's got a Medicare code. I mean, is it ticking enough boxes for you yet? I mean, it's better in every way than the incumbent.
Demtech, you pointed this out to me, and I do really. It's a really cool company. I feel sorry for the guy who's got to look at all those sticky plasters, though. Who's got to sort all them out? That's a nasty job. Yeah, it's the same guy who has to pull the plasters off the bottom of a swimming pool or whatever. That's just nasty. But it looks like Demtech is up 250% on the year.
Yeah.
How overvalued is this company, and are we just in a world right now where everything's just overvalued and we've got to go for it?
Well, I'm going to say no. Actually, I'm going to say there's still a hell of a lot of upside in this company. So their total addressable market, the TAM, is only a couple of billion, but that's based on just this one plaster. They've got a lot of other. There are three main types of skin cancer. They're developing a plaster that can get each of those can detect each of those. They're even looking at trying to get ways of diagnosing psoriasis. But the best part of it is that their total addressable market is based on people having a biopsy. There is going to be a certain number of people in America that don't go to find out about their mark on the skin, the mole on the skin, because they don't want a biopsy, they don't want the stitches, they don't trust doctors. Maybe they're rural and they can't get to a dermatologist. This ties in with telehealth because it can just be posted out to you, applied, taken off, posted back. But the key stat is that melanoma and skin cancer, they're the most diagnosed skin condition in America. They're diagnosed more than all of the other cancers combined. So Demtech is only a billion, just over, I think it's 1.5 billion in market cap. Paul might have the stats up. But it's
currently 1 billion market cap. Looks pretty good. And I did have a look at Demtech myself quite a while ago when you first mentioned it. Was their total addressable market something like 2 to 3 billion?
Yeah, 2 to 3 billion, they reckon. But they're basing that on current biopsies, which, like I said before, I think we can quite safely assume that addressable market is more, and more products in the pipeline. Yeah, I think it's a really, really exciting company, and it's a stalwart in my portfolio. It won't be shifting.
Are we saying it's the Tesla of skin cancer? Is everything the Tesla of something these days? Is that what we're going
Bed
to
Bath & Beyond's not the Tesla of anything. It's not the Tesla of beds or baths or anything beyond.
What you got for us then, Steve W? What were you looking at?
I was thinking I'd offer a nice value stock here, but then Zach jumped in with Bed Bath and started claiming that was a value thing. So, I mean, I've got myself kind of part way through the DD on something that I don't currently own, and I'm, like I say, only part way through looking at it. But it looks really interesting to currently everyone who isn't me, by which I mean I haven't worked out a valuation yet, but it has some nice features that I like in a stock, but I think other people value more. So the company I'm looking at is Roper Technologies. And basically what these guys do is acquire small software mainly, but technology more broadly, companies that have lots of what's called deferred revenue, which basically means someone's paid them for usually a service or a software, and they're still paying that back or delivering their product, service, whatever it is. And therefore they have cash on hand. So Roper buys these companies, uses the cash to then go and buy more companies and builds their kind of business that way. Their earnings have been who has spent the last year watching nearly any kind of tech or security thing go up and thinking, I really don't have the courage or the knowledge to try and pick small cap techs and work out what's going to be a winner out of those things. One way you might try to play out that idea is by having a look at Roper and seeing whether they can do it for you. I mean, their strategy is inherently risky. Growth by acquisition is risky. You have to get your acquisitions right, and they have to do that again and again and again and again. But they've done it reasonably well so far. I mean, their earnings came in pretty much bang on last week. I think it was last Friday, but certainly last week. The tough bit at the moment, and their dividend keeps going up as well in a way that you might appreciate, Paul. You like early stage dividend things. This has been growing by double digits year on year, I think. It's tricky to value at the moment. And that's the bit that I still kind of need to figure out quite a bit. So I don't know whether this is a good price, a bad price. It's going to go higher, going to go lower. But there's lots to get me interested there, and enough to kind of get me interested in trying to figure out what a decent price would be. And lots of other things.
I did look at Roper when you mentioned it. My problem with it was because it's essentially a software company. I don't like these companies that call themselves X Technologies because it makes them sound like one of these big tech companies, and they're just trying to dupe you a little bit. But it's essentially acquires lots of different softwares or develops lots of different softwares, and I'd never heard of any of them. Obviously, they must all be B2B softwares, so that I wouldn't expect to know them personally. It's just one that I thought that you might have to delve into every single program that they have in order to value them, right? You've got to really know this business inside out to really get a good value. Is that why it's taking so long for you to get your head around it?
Partly. I think there's a sense in which you kind of need to settle on management. on that kind of thing. So you could, if you're confident there's really good management there, you might want to kind of outsource the thinking about these things. You're dead right about the kind of businesses they like. They tend to like niche markets, little competition, and that kind of thing. But yeah, I mean, the main reason I'm kind of struggling with them a little bit is their P2E seems absurdly high, and various places seem to think that they're quite good value. I don't think those two things are inconsistent. I think Amazon could be a good value buy with a really high P2E, but I would need to understand better why that is before I get interested in finding an entry. So I'm not in a hurry. I don't know where the stock is going in the near term or anything like that. I'm happy to sit and wait until I get this clearer in my head. But that's one that I thought had a lot of interesting things going for it, if we can find the right price for me.
One of the things I noticed about them was quite interesting was that they're like experts in autonomy. So they're really good at buying companies and making them run themselves, essentially. So that's it sort of reminded me of the old Buffett phrase of buy companies that an idiot could run because one day an idiot will. Yep. And that's kind of Roper's mentality, is that they will buy these companies. They don't always oust the management, but there is a few occasions where I've seen that they did oust the management. But they're experts at making a business run itself, and I think that's where the vast majority of the margins are coming from. They're buying high margin companies anyway, and making the margin even better. So yeah, definitely one for your watch list.
So I guess one important thing, I mean, these feel a lot like Buffett and Berkshire acquiring stuff to me as well. One of the big differences between these guys and Berkshire, I think, is that Roper aren't that keen on pushing money into these companies. They're much more keen on getting money out of them for what it's worth. They tend to like companies that, in their view, don't require a lot of capital. Therefore, they can take capital out and go and use it to make further acquisitions. Whereas in the case of Berkshire, a thing a lot of people have been thinking lately is, well, if you own some companies under that umbrella in a sector that's getting hammered, you can keep them afloat while the competition struggles, basically. Roper don't seem to see things in quite that way. I mean, partly the sector's not struggling, in software particularly. But they tend to prefer companies they think don't take much to keep them running in terms of cash.
That's a good take on Berkshire, to be honest with you, because you never really think of them that way, because Buffett says buy great companies. But at the moment, he is sort of bailing a lot of them out with his deals. And that might be something to think about with Berkshire there.
That was always the same with Buffett, though. He just basically spends 6-7 years loading up his elephant gun. And then the minute there's a crash and people start being in trouble, he just fires that gun all over the place. Oh, what an analogy.
You're getting rescued. Yeah, Buffett just
that brings some horrible memories.
Sprays, just fertilizes all stocks.
Yeah. With his large elephant gun.
Right. Speaking of high PE ratios, although I would say this company doesn't have a particularly high PE ratio at the minute, Facebook is coming back into value at the minute. It might have just jumped out actually, 267. I had it. A lot of people have been rating Facebook at sort of $250 as a good value. But its earnings report came out last week, and some of the highlights I found in its earnings report that were really important were its operating margin was up 50% year on year. And its net income has a 53% change year on year as well. So this company is absolutely smashing its earnings at the minute. Most importantly, though, for Facebook that we see is that its daily active users are 1.84 billion on average in December. So if we're working out that, is that 1/4 of the whole population of the world using Facebook daily?
It's probably more than that, because isn't it banned in China? So you can
I mean, one of the things that people worry about on Facebook is the possibility of some of these accounts being fake.
Especially Instagram.
Yeah, I suppose. Yeah. And do they do anything to sort of get rid of those fake accounts, or do they? This is daily active users. This isn't just like accounts that they've created. Mm-hmm. This is daily used to people making clicks. I mean, I
Logging
suppose
in.
you could say, yeah, I suppose you could say that, yeah, there could be some an army of trolls in India somewhere that are trying to boost people's likes and numbers. That could be something to do with it, maybe.
Probably a few
They
thousand
will.
Briscoe accounts out there somewhere.
Oh yeah. Well, I don't know. Don't put that into people's brains. Jeez.
There is a
But what
person
about-
in the comments who keeps trying to sell us Bitcoin.
What about those
Hey.
fake YouTube comments where they try to impersonate?
Oh God, yeah, they are such a ball ache. They are trying to get rid of them. I've had a few today. They create an entire account just based on you. I mean, I don't know if YouTube does exactly the same thing, because I'll talk about this actually because it's probably quite related to this. YouTube itself does not make it very easy for you to get rid of these accounts. You click report and it goes, or you can hide the user from the channel, but they don't seem to be putting in anything really concrete to get rid of it. And it seems quite easy for them to do. So again, going back to the user thing, are they just happy that that people are creating these new accounts to make the scams? And then they get to put that on their data to say that, oh, look, YouTube's had X amount of new users. We're 11, 12% up new users on YouTube. And, half of them are made just by scamming accounts.
That's true, because they never mention these accounts, do they? So, I mean, even to advertisers, because I used to do a lot of the marketing for on Facebook and YouTube as well. They used to inflate the numbers of people using Facebook and viewership of each ad, etc. So yeah, I mean they never freely divulge into how much fakery is going on. I mean, we do hear about Instagram boosting likes and stuff, and I do know they had issues when they first started up, but I'm not sure about now, to be fair.
Yeah, I don't think it's in their best interest to do this, and it really probably does inflate their numbers. But we've gone through how much money they've got there, and I'm sure they said there was a 25 billion, or was it million or billion? I feel like it's billion share buyback program coming for Facebook right now. They have just a lot of cash on hand that they can't figure out how to spend, so they're going to start buying back their stock. The risks to Facebook right now, though, it's antitrust. No one likes Zuckerberg, do they? Everybody fucking hates him. Is this going to be a problem? Anyone got an opinion on Zuckerberg and the antitrust going out there?
Break them up.
Yeah, I was waiting for that. Just knew that was coming.
Especially what they did with WhatsApp recently. I think people definitely didn't like the fact that they were trying to, was it sell the data for advertising, I guess?
Yeah, WhatsApp, that's traditionally considered a very, very private messaging service, they've decided to make not so private. So Elon decided to tell everyone go and use Signal, who then everyone went and bought Signal Advance or whatever the stock was.
The unrelated messaging app.
It's so dumb, isn't it? It's so dumb.
I only got I think WhatsApp have started doing their own status now on the app, and the first thing they said was end-to-end encryption. No one can dab into what you're talking about, but they completely missed the point with the selling of data, which I don't think they will indulge in, I guess. But yeah, there was a mass exit from the app, wasn't there, recently? I think a lot.
I don't know. I don't actually know. And maybe Facebook's reports suggest the numbers. I haven't actually delved in that far. But on breaking up Facebook, and you can go to antitrust and the others very quickly because we haven't got much time left. But I reckon Steve D's got a big opinion on breaking up Facebook.
Just break them up. They'd be a far better business in pieces. I think a lot of companies would be. But I think breaking Facebook into a Facebook, an Instagram, and probably a WhatsApp where Oculus sits in that. I think Oculus is quite an interesting business that we'd all like to look at. But yeah, break them up. They'd be a far better company with individual CEOs that are focused on their respective companies. And I think they'd it would unlock a hell of a lot of shareholder value.
All right, so we'll leave that there because we've got 10 minutes left. We just want to answer a question that's been left on one of the comments. We did try and answer this to the commenter at first, but it's our first question, and it is quite a good question because nobody really knows us as such. I mean, a few people might know where I'm coming from, but you guys haven't really been outspoken of where you're coming from an investor point of view. And somebody asked, sorry, I didn't do the research to get your name. Is it Jackal? He's on the Discord, right?
Yeah, Jackal. Yeah.
Jackal's on Discord. He's got his own YouTube channel, I believe. He's one of the content creators. Go have a look for his videos if you want to see him there. But he was concerned that we're all just running some sort of circle jerk here and just loving each other. I mean, I obviously, people know me as a sort of dividend investor, and to a point of value play, I'm going to definitely go into more how I value a company in the coming weeks. And yes, I am very strict on the dividend investment style, just because I personally don't feel I know enough about investing and valuing companies, and particularly in growth stocks as well, seeing total addressable markets and things like that. So I find dividend investing as a very easy way to get into stocks, and a way that I understand. I understand the compounding, how it compounds, because someone was asking me the other day about how a normal growth stock compounds, and I had to sort of explain that it's not necessarily in the linear growth that the stock compounds. It's more in how they reinvest their money and how you personally buy and sell and reinvest and add to your positions, which causes the compounding. That's a lot to go into in one sentence, really, isn't it? But yeah, so I come from this dividend, slightly value investing style. Steve D, just give us an explanation of where you come from, because we don't always see eye to eye, really, do we?
No. So I have a sort of core and satellite sort of strategy where the core of my portfolio is safer, not necessarily dividend payers, but stocks that you would consider safer, slower growers. And then I have a satellite part of my portfolio, which is about 20%, which is aggressive, high growth, high revenue increases, not necessarily profitable, price to sales above 30, South American, unpronounceable, and that kind of stuff. So I really like to, really look aggressively in that portfolio, and that's where I spend the vast majority of my time. I know my core is going to be steady and look after me and deliver 3, 4, 5% returns in every good year, and I'm really looking for the 20% of my portfolio to really supercharge the growth.
That's a pretty good strategy. I can actually kind of agree with that one, and I sort of need to rethink my strategy as I learn and grow. Steve W probably hates the fact that I call, he hates the dividend investor kind of label. And we don't necessarily agree on that one either. And I think you're more of a value guy, Steve.
Yeah, I mean, I hate most of the labels, to be honest, but I guess if I was going to kind of attach one to myself, it would be value investing. And that's not to say that I don't care about how much a company is growing its earnings or whether it pays a dividend and how that dividend's faring. I guess what I associate value investing with is caring a lot about the price that you're going to pay for a company. And I think that I see as kind of the main thing that's going to contribute to how well my investments do, whether I get them at the right price or not. I mean, I think it's fair that we kind of all care about what price we're buying them at for what it's worth, but it's definitely true that we don't always see eye to eye on a bunch of things. I mean, Warren Buffett says that really successful people say no to almost everything. And that, I think, is primarily what Steve D is for. He's helped me a lot in my kind of investing career, but most of the time he just sends me stuff and I say no, and I've never heard of this, more or less.
Yeah, because and I can take that part of it as well, of paying the right price, because I think at the moment we are seeing a market where people think they're paying the right price, or they could be. Of course, they could be paying the right price for these stocks. But on the majority and as a whole, I think the majority of people don't believe that they're paying the correct price. It's like going into, I don't know, going and buying a sofa and seeing the sofa for double the price it was the week before and going, oh yeah, that's the price I want to pay. And I just don't like feeling ripped off. I think that applies to a lot of my life as well.
I think that's what I find hardest. If I feel like I didn't pay the right price, but thought, well, I'll go for it, it's not coming down, more or less, and it does move, and then I think, well, I don't even think it's worth this anymore. Then I really hate that feeling of feeling trapped like I've overpaid for something, basically, which is what pushes me towards value investing. It's just a temperament, I think.
Because conviction matters, doesn't it? The thing is paying a heavy price for something is fine in a bull market where the price continues to go up. You can say, okay, these conditions are okay. I think this company is going to continue to do okay. They're very expensive, but the likelihood is they'll get more expensive. But the issue is that when the market turns, you've got to have that conviction, because you don't want to be looking at a price at the stock that you've overpaid for and say, shit, I'm now 60% down, and I don't even really like this stock. I didn't even get it at a good price. So yeah, conviction is key.
And that would be my arguments against the W style of value investing is, where does value investing have you as, you're paying the right price for something, you think you're getting a good deal, versus just being a dumbass contrarian? Are you just not going for the stuff everyone else loves? And you're just going to be left behind because, what you're buying isn't cool anymore. I know I've spoken about that before.
Yeah, maybe. I mean, that's the danger in value investing. I mean, it sounds like playing it safe, playing it careful, but the danger is you just buy stuff that never does anything at all because it's cheap and is cheap for a reason. Obviously, you try and figure out which things are cheap for a reason and which are not. But I'm not suggesting there's no risk to value investing. I think that's exactly the risk.
You have to be a contrarian though to beat the market. If you're buying the stocks that are the market, you will achieve the market return. You have to be a contrarian to beat the market. So if your plan is if that is your benchmark, if your benchmark is just to beat the bank, then yeah, that's fine. Buy the market. But if your plan is to beat the market, you have to be different.
Pinterest.
And Zach, that's for you, right? Zach is the man. What are you doing?
I'm gonna summarize in simple, but no debt, because you don't want to be burdened by debt, because that's where the growth comes, I guess. I guess you have plenty of cash as well. But in a sense, recently I've been buying up a lot of companies that are under 1 billion market cap, only because I want to give them a chance as well. And plus, I only tend to stick around with good management teams. I get asked all the time, why this? Because when it comes down to it, a good team who can efficiently manage money and understand, this is because I come from a marketing background as well, and I think some management teams really know where they want to kind of dive into, and it's a case of efficiency and I guess giving small companies a chance, because a lot of us just pour money into large caps. I'm talking to Teslas and saying, oh yeah, I made 20% return. But what about not following the bandwagon? It's not going to be a popular opinion, but I guess actually going down to the nitty gritty and understanding each company on a smaller scale as well. I think that's probably where I am at the moment.
But this opens you up to a lot more risk, right?
Yes,
that's
it does.
Why you're trading.
Essentially, yeah. I think for me it's where the fun is, in a way, when it comes to picking stocks, because you can't if you're not gonna put your full kind of effort into doing your due diligence, you might as well just pick an ETF, right?
That's the argument. That is a very strong argument for a lot of investors out there. It's, if you don't really have the time, and it's going to affect your life to a point where you're just paralyzed by analysis, then you might as well try and go for sector, and maybe drop down to sectorized and then go for that, and pick your VanEck and your INRGs and all that sort of stuff and go there. And if you really, really don't care, just bung it in an index fund, bung it in the S&P 500 or VWRL, and make your money that way. We all know that consistency generally does pay off in the future. and it's all going to be about your behavioral. We'll get onto behavioral on another episode, I think, because I think that's the most important part of investing out of anything, knowing your stocks and all that. But yeah, we did small caps. So Zarek is actually more a small cap stock, slightly riskier stock, and a lot of SPACs. And I think you're in a lot of SPACs, aren't you?
I did. I was. I've moved out of SPACs. It's a lot more interesting going literally into the penny side of stuff, because you need a lot of conviction.
Yeah,
and I think I don't really want to delve into something that I'm not, fully versed into. Because SPACs, you can slightly get away with it because it has NAV. So it is a case of where I want to literally get into something because I've done a bit of background research into something, as opposed to bandwagoning. I think that scares me.
Yeah, so that's good. That was what we were trying to answer with this, I think, is that we actually all come from very different investing kind of mindsets. A lot of us also come from different levels of experience with it, and we might all be learning off each other. And I think that is the case with this podcast. Is one thing we want to do is learn from each other and have good conversations in this podcast. And we also don't want to, like I said earlier, just be a fucking circle jerk and just like, oh yeah, this is absolutely amazing, I love this one. We don't want to be like that. We want to see the downsides of our stocks, and hopefully talking to people who have different mindsets to us and have different investing styles, different ways of thinking about the market, we might be able to bring ourselves together and talk about some stocks and maybe find some stocks that we wouldn't normally have seen. I think we'll call it there because that is about an hour and 3 minutes into this. I can't believe where the time's gone on this one. So thank you very much for everyone for listening today. I hope that has been at least slightly entertaining and maybe informative. Just remember that, anything we say on here, we haven't got a clue really. I don't think anybody has a clue about the market. So
Tesla.
Try it. YOLO Tesla 420 for life. So this podcast will be on the YouTube. So if you wanted to ask a question a little bit more in depth, maybe, and ask something specific, you can leave a comment in the YouTube section of this podcast, and hopefully people might start to have a listen on their commute or on their run or something to this on Apple Podcasts, on Spotify, and on Google Podcasts. So far, that's where it is. Hopefully that'll be out a few days later than the YouTube one. So thank you very much for listening, everybody. We're always trying to improve this podcast. So if anyone's got any pointers, any constructive criticisms, or if you just want to fucking lob some semen at us through the YouTube comments, feel free. I've gone on a bit there. So thank you very much for listening, everyone, and goodbye.